If there's one thing that can throw off a great financial and retirement plan, it's the cost of long-term care. Do you know if you can withstand the cost of self-insuring for care if you need it down the road? How will it affect your surviving spouse, your kids, and anyone else who may rely on you? These are the questions we answer for our clients every day. And today, I'm going to share how we determine if a client needs long-term care coverage, and if so, which coverage to purchase. For those of you who don't know me yet, I'm Julia, Certified Financial Planner and Managing Director of URS Advisory. I have spent the last decade of my life not only studying finance, but I manage millions of dollars for our clients who are approaching, newly, and in retirement. Every day, I help people retire when they want and how they want. And in order to retire well, you must stress test your financial plan against the rising cost of long-term care, which I'm going to discuss today. Before I get started though, please be sure to like and subscribe to our channel. This helps us get this free information out to as many people as possible, and we really appreciate it. The first thing I want to acknowledge is that long-term care is a very sensitive subject. Both of my grandfathers needed long-term care for different reasons. One needed physical help while the other had dementia, and it had big impacts on our family dynamics. My heart goes out to you if you've experienced caregiving or financial stress, and the goal of this video is to educate you all on what long-term care is, how much it costs, and how to determine if you should invest in long-term care insurance. Let's review what long-term care actually is, as many people believe that it's partially or fully covered by Medicare. While original Medicare does cover up to 100 days per year of skilled nursing care, contingent on several requirements, Medicare does not cover long-term care, which is often referred to as custodial care. This type of care involves help with the 6 activities of daily living: bathing, dressing, eating, toileting, transferring, and continence. It can also mean supervision to make sure that your loved one is safe. Thinking about this type of care is depressing, let's be honest. But we still need to learn about it, as it is one of the biggest obstacles to family and legacy success. And everyone should have a long-term care plan, whether that plan is to rely on government-funded benefits, or buying insurance, or self-insuring. The need for long-term care can arise suddenly, such as after an accident, heart attack, or stroke. It can develop gradually as we age. We can receive care in-home through home health aides, in an assisted living facility, or in a nursing home. Let's review some key statistics that we all need to be aware of. First, 70% of people aged 65 and older will develop a severe long-term care need in their lifetimes. 48% of people aged 65 and up will need some type of paid long-term care services over their lifetimes. And here's the difference. 70% of people aged 65 and older will need care, but 22% of those people will be cared for by family members or friends, spouse, kids, whoever. If you're single, you're part of that 48% that might need paid care. The average duration of a long-term care need for women is 3.7 years, and the average duration for males is 2.2 years. So why is it worse for women? Well, there's 2 reasons. First, women live longer, by about 3 years on average. And 2, women also have higher rates of disability and chronic health problems. Think autoimmune disorders, osteoporosis, etc. In our practice, we pay close attention to making sure that the single women or the surviving spouse has the money available to cover this type of care. Okay, so if you don't have a long-term care policy, how much does self-insuring for this care cost? The answer is very area dependent. For instance, the cost of my grandfather's nursing home in Alabama was so much less than my grandfather's assisted living facility in Florida. So if your financial advisor is testing these scenarios, make sure that they're using local numbers. But let's review some national averages for context. The median annual nursing home cost for a private room is $108,405. The change in median annual nursing home costs runs about 2.41% per year. So, using that, the estimated median annual nursing home cost for a private room in 2030, assuming 3% inflation, is $141,444. The estimated median annual nursing home cost for a private room in 2050, assuming 3% inflation, is $255,463. I'm telling you that so that you could see how the cost of inflation or the cost of living increases can work against you in long-term care. The average cost of assisted living facilities are $54,000 per year, but these typically require some sort of a lump sum buy-in amount. These rates have also been increasing by an average of 3% per year. The median cost of home health aid services is $27 per hour with a similar 3% average increase per year. This means that in 2024, 24-hour private home care costs about $217,000 a year. Safe to say that having private in-home care is by far the most expensive option. When your advisor is stress testing your plan for long-term care events, make sure that they're inflating that cost by 3% so that your analysis is accurate. Doing some quick math, if you're a 55-year-old female and you need care for the average length of time, or 3.7 years, between the ages of 88 and 91, your total long-term care costs in future dollars is over $1.1 million. How would that affect your financial situation? And what if you're married and you guys can only afford to cover one spouse's care needs? In our practice, we use sophisticated software to determine if our clients need long-term care coverage, and if so, how much and what type of coverage makes the most sense for them. Let's review an example using our lead software, MoneyMatch. This software allows us to stress test our clients' financial plans against any obstacle: bear markets, high inflation, early death, and of course, long-term care events. What we find is that the large majority of our clients can easily withstand a major bear market, even during the first few years of their retirement, without running out of money later. But when we add in long-term care events in their 80s and 90s, we start to see their probabilities for a successful retirement go way down. But before we turn to buying insurance, we want to test out other solutions: working longer, tweaking investments to be more conservative or more aggressive, lowering annual spending, playing with the Social Security amount or pension options, maybe funding a bespoke investment account aggressively for long-term care costs, downsizing their home, etc. The idea is to avoid spending money on insurance. But if we can't get the probabilities of financial success back to at least 80 or 85% using these tactics, then we turn to insurance for solutions if our client is young and healthy enough to qualify. A quick word on qualifying for coverage. Unfortunately, these days, you need to be in near perfect health to qualify for most traditional and hybrid long-term care policies, as they conduct their own paramed exams, cognitive exams, they pore over your health records trying to find the one little thing that increases their risk. This means that many of our clients who want and need coverage are unable to qualify for it. I'm not saying this to discourage you from applying, but I do want you to be prepared if you plan to apply to be turned down and to have Plan B ready. Okay, let's review your long-term care insurance options. First, you could take out a traditional long-term care policy. Like many other forms of insurance, car, home, etc., you pay a premium each year, and if you need long-term care, your policy will pay out per the policy rules. These policies have many customizations: how much they'll pay per day of care, inflation protection, your deductible period, which can last anywhere from 0 to 180 days, etc. Unless your policy is much older, i.e. taken out more than 20 years ago, you will qualify for coverage anywhere, from home to assisted living facilities to nursing homes. Some of the older policies may pay only a half benefit for home care, and some don't cover home care at all. If you have a policy, please review your coverage so that you fully understand what you're paying for, as well as your limitations. Here's an example of a policy. Mike at 55 pays an annual premium of $3,000 per year. This gets him $5,000 per month to pay for care with no inflation protection for 5 years. And the deductible period is 90 days. As you can see, the return on investment is pretty high if you need care. A very important aspect of long-term care insurance is whether your policy is a reimbursement policy or an indemnity policy. Reimbursement-based means that you or your advocate will have to submit your bills to the insurance company each month for reimbursement. This means a lot of paperwork and hounding the insurance company to make sure that they make good on their promise. On the contrary, the best type of long-term care insurance is indemnity-based. This means that as soon as your doctor says that you need long-term care, the insurance company will pay your daily or monthly benefit directly to you after your deductible period. This way you can pay whoever your provider is right away without having to prove anything or pay the bill up front. This is much easier and always the best option if available. So, in summary, traditional long-term care insurance gets the job done if care is needed. However, there are some major flaws. 1, if you don't need care, you've just wasted money on insurance. And 2, your premium is not fixed and can rise frequently, putting you at risk for policy default in the future. If you suddenly can't afford your new premium, there goes your policy and all the money you paid in. So, to fix these issues, insurance companies created hybrid policies, or a mix of either long-term care insurance through an annuity or a life/long-term care insurance policy. The most common long-term care annuity rider will double your guaranteed lifetime income payment if you're confined to a facility for at least 180 days. Clearly, these are less comprehensive than traditional long-term care or life-long-term care hybrids, but they're a nice perk, especially if you only need a little bit of coverage to secure your plan. Let's review 2 examples of life/long-term care hybrids. The first is a premium-paying hybrid policy for Al and Sue. They are in their late 50s and have $5,000 per year to put towards a policy. This will give their heirs a $100,000 tax-free death benefit if they never need care, but if they do need care, they will each get $3,000 per month for an unlimited amount of time after a one-time 90-day deductible period. There is no inflation rider on the policy. So, this is an excellent return on investment if care is needed, plus if it isn't, at least their kids get something, right? That $1,000 tax-free death benefit. Also, the premium is fixed for the life of the policy and cannot be raised for any reason. This allows them to plan their budget with no surprises. The second example is the same type of policy, but using a lump sum investment. Let's say they invest $150,000 cash into a hybrid policy. They will each get $5,000 per month for 5 years for a total bucket of money of $600,000. If they don't end up needing care, their heirs will receive a $185,000 tax-free death benefit. This is a great option for those with excess cash that want to avoid a lifelong premium payment. These can also offer a return of premium feature, so if you change your mind after a certain number of years, you can get your premium back. Like the traditional policies, you'll want to know if it's reimbursement or indemnity-based. Now, some of you might be thinking, what's $5,000 a month going to really do for me if the average cost of care is already over $100,000 per year? And the answer is this. Most retirees do not need the most comprehensive or the most expensive long-term care policy. They only need to cover half or a third of the cost, as they have other assets to cover the rest. The idea is to hedge your risk, not to overinsure and pay a fortune for a large policy that you may not need. All right, folks, now you know what long-term care covers, how much it costs on average, and the insurance options available today. If you have any questions or experience with long-term care or long-term care insurance, please don't hesitate to comment below or to reach out. If you found this video helpful, please be sure to like and subscribe, and I'll see you next time.